Stocks are lower, but they're off their lows now. A big two-day rebound, of course, leading up to this. And the Nasdaq is flat just for the moment to keep you appraised of what's going on in the markets. Joining us now is Anne Lester, Portfolio Manager and Head of Retirement Solutions at JPMorgan Asset Management. And we're delighted to have you, and congratulations on your Morningstar Gold Medal.
Thank you very much.
You're Head of Retirement Solutions. What is the solution? And tell everybody who wants to retire at a regular age what they can do to get that rate of return that will enable them to do that.
Well, I think there's two things to the equation. One is making sure you save, and if you don't do that, the return rate doesn't matter at all. The second thing, though, is being in a diversified portfolio. I happen to help run our target date funds. We think that's the best way to save for retirement.
You've got 125 billion or so in assets under management, people's retirement savings that they've been, putting away bit by bit. When a market event like what happened in the last few days happens, do you get calls, or are people generally satisfied that, the measly return they're going to get these days anyway is...
Well, I wouldn't say measly, right? So from our perspective, right, we're trying to manage these target date funds, our smart retirement portfolios, over a 40-year cycle. We think for the next 10 to 15 years, you can expect 6-7% return. I wouldn't call that measly. If inflation's at 2.25, that's not a bad return. But you have to get in and stay in. Now, the benefit of a target date fund or any kind of asset allocation fund, especially for someone in a 401k plan, is that they're generally content to put their money in and check in once a year. And that's the messaging we give them.
I do feel like now we're touting 6 and 7% as, a good return, but there would have been a time not that long ago when that would have been cause for real concern. Your assumptions have changed then.
Yes.
What are your assumptions when it comes to retirement age and rate of return?
So retirement age, we think the industry convention is targeting 65. I think one of the things we are all starting to talk about now is the fact that simultaneously, with Social Security going up, I think many Americans are now comfortable and indeed embracing the notion of staying engaged in the workplace longer and having more phased retirement. So maybe 66, 67 is going to be the new 65. In terms of rate of return, if we project forward that 6 to 7% and somebody is saving 10% a year and their employer is contributing, let's say 3-4%, they're going to be just fine. But the trick is making sure you're saving and staying invested.
And it's Nejra in London. I know you look long-term, but a lot of people are looking over the past week trying to work out what happened and what happens next. I just want to show you a chart here, 7764 on the Bloomberg. I don't know if you can see it, but basically it shows positioning speculators short 2 and 10-year Treasury futures. But what's interesting is that they've kind of started to go a little bit less short on the front end. Does this chart tell you that we might see some more curve steepening? We've seen a little bit in the past few days.
I find it fascinating that, a month ago, everybody was worried about the flat curve predicting a recession, and now we've got a steep curve.
Yeah.
That means we're worried about growth accelerating maybe more than we were expecting. That's why we're asset allocators. That's why we have a tactical, flexible approach to managing money. We have to be able to respond to those views. This is why diversification is important. You want stocks, you want bonds, you want global, you want to have a view on the interest rate curve, but you also want to have that tied back to your overall view on the macroeconomy. And when we look at the recent flow of data, we don't think we're any closer today to a recession than we were yesterday or 2 weeks ago or at the beginning of the year. We do want to keep a close eye on inflation because that's what everybody's worried about. But so far, we don't see anything that we think fundamentally changes things.
If you're not too worried about inflation, then not too worried about a recession, what are you worried about?
Well, I think it's actually the risk that we see, out there is that we are underestimating full employment. Maybe we're closer to that number, and maybe there will be a little more inflation out there. So again, if I had to put a sort of normal worry on the table, that's one. Policy error. Is the Fed going to be perceived as being behind the curve if, in fact, we continue to see this boost? Again, the fiscal package that was just announced is another source of stimulus into a very sort of full economy, full employment economy. So those are all things we want to keep an eye on.
You have about, 23 or 4 target
date funds? Yep.
The Income Builder Fund has the most assets under management in it, as far as I can tell from the Bloomberg. JNBAX is the ticker, and you're in things like, Pfizer and Microsoft, Novartis, Rio Tinto. So there's a lot of large cap names there.
Things that pay lots of dividends, yes.
Now, what are you anticipating for dividends going forward, particularly with repatriation, particularly with shareholders clamoring for more and more and more?
Well, so it's interesting when you look at the U.S. equity market. I think it has, going back in history, had very interesting dividend yields, but certainly for the last 2 decades has lagged far, far behind Europe and Asian companies in terms of generating an attractive dividend yield. One of the things we have been observing is that those dividend yields have been going up relative to, say, the 90s. And we think that that can continue to be an attractive source of yield. But when we look at the U.S. equity market vis-a-vis Europe and, certainly outside of Japan, a lot of the Asian equities and even some emerging markets, we see much higher dividend yields outside of the U.S. So we do own a lot of big American dividend yielding stocks, but from our perspective, Europe's actually a more interesting play, both because of where their valuations are and because the dividend yields are higher.
Fascinating. The Smart Retirement 2030 Fund, I'm curious about this one too, because that's, not that far away. People are looking at 2030.
Where all my money is, yep.
Well, where are you investing bond market-wise for the safety of being able to retire at 2030?
So what we do is we have positions in sort of our core bond fund, and this is a fund-to-funds approach, so we invest with other investors. We're not individually picking stocks and bonds on our team. And our core bond fund is basically underweight treasuries and overweight credit, which we think is still really appropriate. Again, treasuries we think are some of the most expensive assets out there. We also have a lot of exposure to high yield and emerging market debt, so extended credit, which we think is a great way to play the recovering and recovered U.S. economy without necessarily having as much risk as the equity markets would give us.
I love that you have a 2055 fund as well. And we have to leave it there for now, but we do hope to have you back very soon. Anne Lester is Portfolio Manager and Head of Retirement Solutions. She has all the answers at JPMorgan Asset Management.